The Fed's lost the script, and it's time to wake up to the new reality. Stablecoins are rewriting the rules of finance. Are you ready for the disruption? Solar energy is out, and nuclear is making a comeback. Let's talk about the energy pivot. Nvidia's SMR play is changing the game. AI wants its own reactors, and it's happening now. Stick around as we show you how to hedge like a pro and navigate this wild market. Watch till the end to truly understand what the market's really doing.
Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and individuals like you to help you get better returns in the stock market. I'm here with our host, Rob Ferry, and he's the CEO and founder of Flying V, our digital marketing partner. Rob, how was your week?
Week was great, Gary. Really looking forward to getting this week started. I know we're filming at a little bit different time Monday morning, at least for me. I know you're still over in Europe. But yeah, bringing you the news wherever it may be coming from. Obviously, we had crazy weekend. I think before we even dive into five things, Gary, just any overall thoughts, just macro environment. Obviously, we had the big news about the U.S. attack on Iran. But yeah, I think before we do jump into this version of the five things, just given your high-level thoughts, macro level, just over the events on the weekend.
Yeah, so it's a great question, Rob, and there's an enormous amount of uncertainty. I'm reading, I've read some reports where the United States and Israel have claimed they completely wiped out the Iranian nuclear capacity. I've read reports where Iran said, yeah, you wiped out our nuclear capacity, but we moved all of the highly enriched uranium out of there. Something that has been denied and confirmed by the U.S. government and the Israeli government. At various points, they've said, no, we got the uranium. At other points, they've said, yeah, we actually believe Iran moved it out. By the way, worth pointing out, Iran has claimed many, many times that their nuclear program is only for civilian energy use. If that's the case, why do they need highly enriched uranium, right? I mean, this is, that itself, I think, is really interesting. There were some reports that the U.S. had a direct hit on the three different mountain areas where Iran has their highly shielded nuclear program buried underground. We have the massive ordnance bunker buster bombs that, basically will blow up a mountain, and then we send in explosives and blow all that up. But there were reports that, no, we only blew up the road to these facilities. Iran over the weekend was saying we're going to close the Straits of Hormuz, where 20% of the world's oil flows through. That would cause oil prices to go up a substantial amount, maybe a little bit less than double. I've seen a lot of estimates that say, we'd go from like $80 a barrel, $70, $80 a barrel to north of 120 if that were to be the case. And they've talked about mining the waters. And then there have been various reports that A, they haven't done it, B, they could do it, C, the US government is saying, no, we've got the Navy, we can prevent them from mining it. I don't know that we can prevent them from closing the straits, but either way, there's just been an enormous amount of uncertainty in all directions. The one thing that I do think is pretty funny is in Tehran, there is a billboard they have where the mullahs are counting down the number of days or hours until they think they're going to destroy Israel. Israel on multiple occasions has blown up that particular sign just as a, hilarious, you're not counting us down. We'll see. President Trump, to his credit, has said, come to the table. We do not need to launch any more missiles. We'll see if the Iranian government manages to accept that offer, or, if they've talked about activating sleeper cells in the United States, something that they probably have been able to do. There's no question they've sent people in through our previously unguarded southern border in prior years under a prior administration. So, there is danger that there are sleeper cells in the United States. That wouldn't surprise me. And then there's also talk that they'll respond, but that it would be a symbolic response. I know one of the things that they've done is they've said to the United States, we need to respond so we don't look weak. And the United States has said, okay, we'll go bomb this, this site or this military installation, but the US will pull critical equipment and personnel out of there so that, Iran gets to say we blew up something of the United States, but we don't lose real assets or people. Basically, the amount of misdirection here is so great that even US government sources are contradicting themselves within hours. The press sometimes tries to play that off as a lack of organization in the administration. I don't know that that's the case. I think sometimes in the fog of war, it's really difficult to know what the truth is. And sometimes people's understanding of a situation will change over time. The only thing I can tell you is that from an investing point of view, the DKI portfolio is well hedged against potential market disruption, and we are well hedged for future inflation and higher energy prices. So, look, I'm certainly hoping there won't be more bloodshed. I'm certainly hoping that the missiles going back and forth won't be launched and that people will be safe. But on the investment side, we are well protected to manage through a situation like this. Obviously, this is a situation where I'm on top of the news constantly and, even through the middle of the night.
Yeah, no doubt. Great update there, Gary, just on what's happening over the weekend. We'll dive right now into this week's version of the 5 things the powered by nuclear power issue. Obviously, be talking about nuclear. We've got Fed updates, Genius Act, new solar wind legislation, and then we'll close things out with our 5th and final thing, educational topic on hedging with DKI intern Cash and Crow. Gary, let's jump right into it, though, for this week's version. We're coming out. We're going to be talking about the Fed. They did not cut, as I'm sure a lot of people watching this already know. The dot plot gets hawkish. You're saying, hey, this doesn't matter yet again. Gary, thing number 1, it's all about the Fed meeting.
All right, Rob, let's go through the news before we get to the conclusion. So the Fed meets every month for 2 days. And at the end of their 2-day meeting, they come out and, it's like Groundhog Day, and we see if Jerome Powell sees his shadow. But what they do is at 2 p.m. on Wednesday, they issue a press release that explains what the Federal Reserve has done or not done. And then at 2:30, Jerome Powell, the chairman of the Fed, meets with the press and has a televised press conference. So last Wednesday, the Federal Reserve came out and kept the Fed funds rate unchanged. This surprised exactly nobody, but there was news here. June is one of the 4 meetings a year where the Fed provides a dot plot. So for people who don't follow this constantly, the dot plot is where 4 times a year, each governor of the Federal Reserve puts a dot where they think the Fed funds rate will be at the end of this year, next year, and the following year. They give the projections for inflation, for GDP. It's a sense of where the organization is on an individual level. Now, nobody signs it, but each governor does get a dot. So even though the median expectation for this year remained at 2 25 basis point rate cuts, fancy way of saying half a percentage point, the details were much more hawkish. The number of Fed governors who now expect no rate cuts almost doubled from 4 in March to 7 now. So many more Fed governors are saying, we don't think we're going to cut at all. In addition to that, Chairman Powell dropped this particular bomb during his press conference. Ready for this one, Rob? The chairman said, we expect a meaningful amount of inflation in coming months. That was not what the market wanted to hear. You could see in real time the market dropping when he said it. Sure, that comment was temporary tariff related, but it wasn't what the market wanted to see. But, like I told you before, at DKI, we are completely unconcerned by any or all of this.
Yeah, so Gary, you say that and unconcerned about this report, dot plot, what that looks like means. Why is that? Can you explain for the viewers why there's just this lack of concern from your side?
Well, first of all, These kinds of things, changes in the Fed funds rate do move the market. But one thing we're going to talk about later in this episode with Cash and Crow, our intern from the University of Tennessee, is that our portfolio is heavily hedged. When I wake up in the morning, I'm focused on the news for our positions and our stocks, not where the market's going to be. The next thing is the Fed has a horrible track record at predicting its own year-end Fed's fund rate. We actually tracked this, and one of Cashin's predecessors, Andrew Brown, also from the University of Tennessee, did great graphs on this a year or so ago. And typically with 6 months to go in the year, Fed projections are not worth a whole lot. So what the Federal Reserve thinks today bears very little resemblance to what they're likely to do by the end of the year. Now, let's give Chairman Powell credit here. To his credit, in the press conference, he actually said out loud that the Fed has a lack of confidence in their projections. And so, what I can say on that is that I admire his honesty and I agree with his conclusion that the Fed really doesn't know what's going to happen. And let's give him credit for saying that out loud in public. He's right, but not many people have the guts to say it. So good for him for admitting that. Finally, Rob, the market focuses a lot on the Federal Reserve, but there's really not a whole lot they can do at this point. If they were to, people are worried that if the Fed doesn't cut, we're going to have interest rates that are too high and it'll slow the economy. But if the Fed does cut rates, what will happen is the bond market will price in higher projected inflation, and it'll lead to higher long-term rates. And this leads to something we've talked about in prior versions of the 5 things, but it's really important. Many people incorrectly think that the Federal Reserve controls interest rates. They do not. They control the Fed funds rate. That is the overnight rate. Everything else from a week to 5 years to 10 years to 20 or 30 years is set by the bond market. And so if we go back to last September, October, November, during those 3 months, the Federal Reserve cut the Fed funds rate by 100 basis points, 1%, but the yield on the 10-year actually rose by 100 basis points. And the reason is the bond market was pricing in higher future inflation. So demand for treasuries will rise and fall with geopolitical conflict, but long-term inflation and treasury yields are going to rise with continued massive deficits from Washington, D.C. The only thing that can save us from higher rates is a reduction in congressional spending. That's not going to happen regardless of whether Team Red or Team Blue is in charge of the place. Both parties will always spend more no matter what. So I think the Fed they're painted into a corner. There's just not much they can do. But Rob, let me ask you, as the CEO of a small but rapidly growing business, how does this affect you? Do interest rates matter for you when you're running Flying V?
Yeah, good question, Gary. I mean, I think for us, we've been a small bootstrapped business since day one, right? So we haven't taken on investment, a lot of debt either, right? So obviously, yeah, we're keeping a pulse on just regular interest rates, the market, the Fed funds rate. We are growing though, and are looking to scale. So we're looking at, what our potential opportunities for capital, line of credit is something we're exploring right now, right? So just either stability of cash flow, right, or for us to inject capital quicker than just organic growth that we're seeing through the business in certain areas. So I think that's an area where, yeah, when we're definitely making changes to how we finance the business or capital opportunities, looking at that. But I think from running the business, it's more so just been how has the interest rates affected the macro environment and our clientele, right? I think is where I see the biggest fluctuation. So, I think at the end of the day, media buying, marketing, and advertising, right, it's a big piece of the macro economics to where, when we do see the market contract, we see advertising dollars get cut, right, in certain areas. Obviously, there's correlation with rising interest rates and whatnot and how businesses are attacking the market. So, but I think, again, it also is mentality too, right? So obviously, hey, when blood in the streets, there's opportunity for growth, right? So I think it depends on the mentality of the businesses that we work with too, to where, hey, when when everybody's contracting or pulling back or cutting spending, interest rates are high, that's when I think some of our best clients get more aggressive, right? Because they see opportunity in the market while everybody may be worried, unsure, uncertain, etc. So yeah, we keep a pulse on it. But again, I'd say for us, more effect on what it does for our clients, their spending habits, budgeting, right? And then more so just that in uncertainty. When there's uncertainty, it's harder for people to spend marketing dollars. When they're more certain about the economy, just general performance, less volatility, then obviously it makes it much easier for them to allocate those resources towards growth, towards new initiatives for bringing in new business to the organization. So yeah, we keep a pulse on it. And right now, yeah, with line of credit, we're looking at some capital injection. Definitely, obviously, keeping an eyes on what those rates are and what our buying power is on any given week. So,
Rob, one of the things you're doing that I think is really smart is looking for those lines of credit now before you need it. I had this conversation with somebody many years ago. She was looking at buying something and she said, I want to take on the least amount of debt possible. I said, why? She said, well, because I don't like debt. I don't want to have debt. And I said, no, you should get as much cash now as possible. She said, why? If I need cash later, I'll just go get a loan then. And I said, because that doesn't work, because when you need money, nobody will lend to you. She's like, well, that makes no sense. I'm like, well, from our point of view, it makes no sense. But from the point of view of the bank, right, lending to somebody who needs money, who doesn't have cash, that's a problem. So I think you're really smart in thinking about locking down a line of credit when you don't need it, because now is when you can get it. If you're in a situation where you desperately need it, the answer is either going to be no or maybe, but with really bad terms.
That's exactly right. Yeah, you got it, Gary. So yeah, definitely being proactive, putting yourself in a position, forward thinking. What type of moves do you want to be able to make, and having that flexibility? So yeah, I think that's great advice just for individuals as well.
Gary, and by the way, one other thing to think about, you were just talking a minute ago about how interest rates may affect your clients. And, you run a marketing firm. If business isn't good, you always have the ability to say to them, well, don't you think you should invest in growing it?
I would always say that, yeah, we play a little bit inverse of the market, right? At least that's my philosophy, right? Maybe a little bit sales forward, but yeah, it is true, right? It's like, okay, well, if you do have business contracting, it's not as easy to acquire new business, or you need new business growth as a catalyst. Marketing is a great option. Gary, moving on to thing number 2. We're going to talk about the GENIUS Act here. We've seen some progress be made for approval. This has to do with stable coins, which I know you'll break down here in a minute. Obviously, huge market opportunity. We're still a little bit uncertain with what all this means. You're going to break that down for us. Thing number 2, Gary, the Senate gives the green light for stable coins.
All right, so the Stablecoin Act here, it's referred to as the GENIUS Act, stands for Guiding and Establishing National Innovation for U.S. Stablecoins Act. Rob, Congress, they come up with worse titles than I give you to read on this show. They have worse titles than I do. All right, so let's just start with the most basic things in the world in this situation. Let's just explain what a stablecoin is. All a stablecoin is a type of cryptocurrency that has its value pegged to another currency or commodity as a form of payment. So in this case, we're talking about dollar-based stablecoins. So let's say, Rob, I say to you, well, here, Rob, you want to do certain things on the blockchain. You want to go pay for things, or you want to sell one cryptocurrency and buy another. Hopefully you're selling a cryptocurrency and buying Bitcoin, right? Instead of having to constantly move your money into dollars, you could just leave your money on the blockchain in another cryptocurrency in the form of a stablecoin, in this case, a dollar-backed stablecoin. Now, the key thing here is we want to have stablecoins that are fully backed by dollars or short-term treasuries. And the reason that matters is the last thing you want is to own a stablecoin that's not fully backed, and all of a sudden, you think you have something that's worth $1, And, because there aren't enough dollars to back it, people exchange their stable coins for dollars, and then you're left holding a worthless stable coin. Nobody wants to see that happening. So by giving guidelines and a regulatory framework, it opens up the opportunity for all kinds of financial institutions to issue stable coins. So, one of the things that can create friction in finance are regulations. And in many ways, we're overregulated. Our corporations, our individuals, we're overregulated, and it's a horrible tax on all of us. But the advantage of regulation is companies can say, hey, Congress, or hey, court where I'm being sued, Congress gave us guidelines. We followed those guidelines. We followed the regulatory framework. Therefore, what we're doing has been blessed by the government, and you can't sue us for it. And it is absolutely crucial if you want to have a financial products and services that are widely accepted. You do need to have a regulatory framework for it if you want to do these things in the United States. Now, in this situation, the dollar-backed stablecoins will either be backed by cash, so every dollar of stablecoin will have a dollar being held, or alternatively, short-term treasury bills, in this case, 91 days or shorter. That's to prevent duration risk. And as a reminder, a couple of years ago, we had banks like, help me out, was Silicon Valley Bank, First Republic, a couple of others that failed. And it wasn't that they didn't have treasuries, it's that they had taken duration risk, that basically they had short-term deposits and their assets, those treasuries were long-term, they dropped in market value. Had they been able to hold them to maturity, they would have been okay. In this case, because stable coins are intended to be traded regularly, they need to be liquid and not have duration risk. So that's where we are on this. And, I think having that kind of regulatory framework is fantastic. There are a ton of implications for this, but I'm looking forward to seeing this bill approved.
Yeah, so Gary, you're excited about the Genius Acts. I mean, what will be the biggest impact? Let's specifically talk. I mean, we mentioned Visa, American Express. You mentioned businesses like the banks. I mean, what's going to be the biggest impact for them with this Genius Act?
So there are huge risks to companies like Visa, MasterCard, American Express. Imagine a situation, and by the way, those companies make billions of dollars a year because they charge us all. And people say, no, it doesn't cost me anything. I don't pay for that. I just, if I were to go to a store and an item is $100, I can give them $100 in cash or $100, on my credit card. And then the same $100 comes out of my bank account to pay the credit card company. I don't pay anything, but you do. Those stores are charging an extra 2, 3, 4% because they're paying the credit card fees or the swipe fees, right? Just because you don't see it doesn't mean you're not paying it. So there is a huge threat to companies like Visa, MasterCard, American Express, because the stable coins could be used to bypass the credit card fees and debit fees altogether. In addition to that, let's just take a minute and think about how banks make so much money, right? It's not because they do their business for free. They charge you. They give you a small amount of interest, but charge you a huge amount of interest. In addition to that, right, there are all kinds of fees for wire transfers. They charge you to have access to your money. They charge you for checks. They charge you, just all kinds of fees for everything and just transferring your money. Think about the ridiculousness of if you go into a bank, they may say, hey, you want access to your cash? What are you going to use it for? And my response is, it's none of your business. Well, then we may not give it to you. I know people who have gone to a bank and said, I would like my cash. And the bank has said, well, what are you going to use it for? And they've told them, and the bank said, no, we don't like that answer. We're not giving you your cash, right? I mean, this is a horrible business model, but in the meantime, the bank is holding on to your money. They're making interest from it. People pay billions of dollars of fees a year to banks. Well, what if those fees were wiped out by stable coins? So the bank that figures this out could end up making a ton of money. The banks that don't could see their business models under threat. The other thing to point out is that under current regulations, stable coins will actually be safer than putting your money in a bank. Now, I know that sounds crazy. People are going to say, oh, no, crypto, it's used for scams. Well, maybe not. A 100% backed stable coin is much safer than a fractional reserve lending institution like a bank, where they, for every dollar of deposits, they may have made $10 of loans, right? They don't have your money. If everybody went to the bank and said, hey, I'd like my money back, the banks don't have the money to pay you. It's not possible. But if stable coins are backed one for one by dollars or liquid treasuries where there's no duration risk, or just, maybe a couple of months of duration risk, not enough to really matter, that's a situation where literally every stable coin could be redeemed for $1. So this is a huge threat to banks that depend on taking you guys for huge amounts of fees and fractional reserve lending, where their assets are much greater than, their liabilities are much greater than their assets.
And then, Gary, just for the regular consumer too, it sounds like a lot of net benefits there, just in terms of banks' abilities with the prior scenario, right, to just charge for every possible thing you can imagine, every fee, control over the money. What does this do for the regular consumer?
So, Rob, this could be an amazing thing. First of all, for the people watching this now, I want you to think about two things. One, do the banks charge you a lot of money? And just even myself, like, I regularly wire money. The banks charge me every time I want to wire money, and also think about the aggravation. Even, I'm trying to transfer money from one account to another, and they say, or wire money, even if I'm paying the fee, they say, well, we'll try to get it done today, but maybe by the close tomorrow. It could take them a day and a half to send my money to me or to you, Rob, or at another institution. In the meantime, while they're doing that, they're holding on to it and collecting interest. So if anybody likes those fees, I'd love to hear from you. I don't know why you would. But there's also friction. Like, raise your hand. Do you like dealing with the banks? Is it fun? Is it easy? Think about the aggravation of setting up accounts and what it may entail to get your money and waiting on hold with these 800 numbers. Imagine what can be done with a stable coin. Imagine a situation where your employer, instead of paying you direct deposit into your bank, they pay you into your stable coin account, and you have that money. And by the way, there are already institutions paying interest on stable coins. You could actually be getting more interest in a stable coin. You could get that interest instantly. And so, Rob, with a stable coin, if you said, hey, Gary, I need you to send me a certain amount of money to cover these fees, or, advertising fees, we've just paid for something. Instead of having to do it through a bank, I could send it to you cost-free, no fees, instantly. You'd be able to confirm it while we're on the phone, right? So what it would allow for consumers is a reduction or elimination of fees, receiving higher interest immediately, reduction of all kinds of regulatory and bank rules that make your life miserable. It could make dealing with your finances a lot easier, a lot faster. You'd spend less time with it. Opening accounts would take you less time. There are all kinds of ways that stable coins could, to the benefit of you, right, individuals, completely disrupt the banking and credit card fee-based system. This whole thing, it may take a little while. It may take a few years for this to be sorted out from a legislative point of view and from a market point of view, but it is coming, and it could make your life a whole lot less expensive and easier.
Awesome. Love to see that development. We'll keep you in tune with that Genius Act and any progress that gets made there. Again, you're watching this week's version of The 5 Things, the Powered by Nuclear Power issue. We bring you everything you need to know in the financial markets, investing for each and every week. Show drops Tuesdays, 9 a.m. Pacific time, Eastern time, as those markets open up to roll out the week. Gary, moving forward, we're going to talk now solar, wind, and new proposed legislations that rolled out. You're saying DKI subscribers are going to love this from a profit standpoint. Gary, thing number 3, solar stocks plummet while nuclear gains on Senate tariff bill amendments. What do we need to know?
All right. So, Rob, this isn't done, but the Senate version of President Trump's big, beautiful bill proposes a substantial rollback of solar and wind tax incentives. Those credits would shrink to 60% in 2026, vanish entirely by 2028. That is well ahead of the current 2032 deadline. Solar stocks got obliterated on this. It's actually not a bad thing. First of all, solar and wind are not environmentally friendly. If you think I'm wrong, take a look at what's involved in mining the kinds of elements used in solar panels, or the amount of oil that's used in the blades of windmills. On top of all of that, for that kind of energy to be effective and to be usable on the grid, you need massive battery storage. Otherwise, it's not reliable. If that's the case, take a look at the environmental devastation caused by lithium mining. They're just not reliable. They're expensive. They're not environmentally friendly. It's just you don't see the environmental devastation. It's somewhere else. It's in other places. And so the other issue, Rob, is that these kinds of industries, solar and wind, really only exist because they've been supported by government subsidies. They've never had to stand on their own. That's why these stocks got obliterated. Now, the other side of that is the bill actually extends tax credits for real renewables like nuclear, geothermal, and hydropower through at least 2036. Those forms of energy are much more environmentally friendly and they're reliable. And so that led to immediate gains in related equities. The global ex-uranium ETF jumped over 35%. Shares of other nuclear energy firms rallied. And the legislation reflects a growing policy pivot toward clean, firm power that can provide consistent baseload. There's finally starting to be bipartisan recognition that grid reliability and stability requires more than intermittent renewables. The fact is, if you're listening to this and you want that AI-powered future, that means reliable energy. And if you want it to be carbon-free, your options really are things like hydropower, geothermal, or our favorite, nuclear. So I think this is sending us in a much better direction in terms of national energy policy.
Yeah, Gary, it sounds like some of the benefits of geothermal, hydropower, nuclear you laid out. Is that why the government is prioritizing that type of energy? How might they be different from the solar and wind? I think you touched on a little bit of that, but is that why the government is prioritizing these types of energy creation?
Yeah, I think that's the case, Rob. I think the government is looking at two different things. One is that nuclear power, in terms of being renewable and carbon free and clean, that's the way to go. Solar and wind have a really bad environmental history. Again, people say, "Oh no, it's clean. Look, I'm getting energy from the sun." Yeah, but look at what is required to build those solar panels. It's a lot of environmental devastation. Also, disposal of solar panels, it doesn't go well. You end up with a lot of really bad elements in landfills. Whereas nuclear is just much easier to manage. The other thing is, people are realizing that for national security, just for quality of life, we need a reliable grid. Solar works when the sun is out. Wind power works when the wind is blowing. And, that's great, but you don't have it all the time. And again, batteries require huge amounts of lithium. That's not environmentally friendly to mine. So there are all these issues. Nuclear is really a much better option for this. And for reliability, people are realizing, wow, each one of these AI data centers that we need to be building, unless we want to lose, the AI race to China, and we don't, right? But each one of those individual data centers could use as much energy as an entire city. So you need reliable energy. This is the direction they have to go.
Gary, in terms of just from an investment standpoint, I mean, how do you make money on this? What's the opportunity? What do you see for DKI subscribers?
So we've done this in multiple ways. There are multiple companies that we own that have exposure to higher energy prices, in particular nuclear power. One of the ones we've talked about a lot recently is Talent Energy. We started buying that at $120 roughly a year ago. That stock, I'm taking a look right now, is at 291. So it's up 2.5 times. A huge credit to Enrique Abeda from HX Research, who not only came up with the idea, but he did a webinar with us. For any of you who are curious about the investment thesis there, that webinar is up on DKI's YouTube channel. It's still up there. You can hear me talking with Enrique about his research on this for about an hour. He's fascinating on it. We also own huge uranium positions. And in fact, I increased my personal uranium position 2 weeks ago, and that is up more than 12% in just 2 weeks. I can't promise you we're always going to see positive results that quickly, and be up 12% in a couple of weeks. But I think knowing what we're doing in real time, particularly in this space, is worth a subscription price.
Yeah, no doubt about it, Gary. And definitely exciting things happening in uranium space, and DKI subscribers know we've been holding positions in the uranium space for quite some time now. Gary, moving on to thing number 4. So we're talking Amazon, Microsoft, access to nuclear power, lots of fun stuff, big players here. Now we've got Nvidia investing as well. They're working to build SMRs, small modular reactors is the abbreviation there. Obviously, this leading to more AI data centers, right? The race to push AI, the race to create profitable AI investments. Gary, thing number 4, Nvidia invests in TerraPower as AI pushes nuclear into the spotlight, further confirming DKI thesis that you've had for a couple years now, I think, Gary. But
it's more than that. Yeah, we've owned uranium for years now. But in the meantime, Rob, this is something we've been talking about all year. So earlier this year, Microsoft contracted to buy nuclear power for their AI data centers. Great. That fed right into our uranium thesis. Prior to that, Amazon contracted with Talon Energy for clean nuclear power, reliable power. And that helped us, with our Talon Energy position and our uranium position. We made money multiple ways on that. Well, Nvidia came out last week and said, hold my beer. Their venture capital arm called N Ventures joined a $650 million funding round for TerraPower, which is a nuclear startup, bringing its total private capital above $1.4 billion alongside a $2 billion Department of Energy grant. TerraPower is developing SMRs, that stands for small modular reactors. Each one of those, and to give you a sense of how small these are, you could fit one in a shipping container, right? So imagine having a building where you got a shipping container out back and it can power, like you can stick it in the parking lot, right? Give up a couple of your parking spots, you have enough energy to power a city. These SMRs have a 345 megawatt sodium cooled fast reactor with integrated molten salt energy storage capable of boosting peak output to 500 megawatts. Rob, I always give you hard things to say. Try to imagine me saying this. But in the meantime, the point here is you have about 350 megawatts of consistent power. They can peak it to 500 megawatts. Construction has already begun on non-nuclear infrastructure, and making this a wonderful recursive investment. NVIDIA's AI infrastructure demands energy that's consistently available. Political and social demand mean it's got to be carbon free. That means nuclear. And the recursive part of this is TerraPower is embedding NVIDIA's AI tools for everything from predictive maintenance to reactor design optimization. Basically, we're using NVIDIA AI to build the power source for NVIDIA's AI. I know it sounds crazy, but the whole thing actually works. We're thrilled to see it.
Wow. Yeah, very impressive there, Gary. So obviously we have new energy demand. It's AI related, right? With the rise of AI, the computing power, the use of the technology, right? Which continues to expand faster and faster and faster. I guess my question is, we're honed in on nuclear. Why does that power, why does the energy have to come from nuclear versus some of these other alternatives?
So look, Rob, if you're running an AI data center, or really any data center, you need like 5 nines reliability, right? That power source better be working 99.999% of the time. Anything less than that, right, you're having all of your servers go down. So your options in a situation like that are nuclear power, or listen, if you're right by a dam, I guess hydro power would work, but in the US you'd really need like natural gas or coal. And the problem is, for political and environmental reasons, building more coal or natural gas plants is just not politically feasible. It's also not feasible for companies like Nvidia or Microsoft or Amazon. They've made commitments to have carbon-free data centers. Whether that's right or wrong doesn't really matter. Whether you agree or disagree with global warming or global weirding or climate change, it doesn't really matter. From a political point of view, this is what is available. And so it's going to have to be, if you want reliable carbon-free energy, your option is really going to be nuclear. That's what it has to be.
And then, Gary, these SMRs, touching on those a little bit more as well. So again, SMR, small modular reactors, other than size, or is that the biggest benefit of these reactors? Can you talk a little bit more about those?
So these reactors have a whole bunch of incredible benefits. One is size. So like I was saying before, imagine having a data center that requires enough energy to power a city, and you could do that by just giving up a couple of spots in your parking lot. That itself is absolutely incredible. The power is relatively inexpensive because these are small modular reactors. Once they get the design set, they can be rapidly produced and done relatively inexpensively. So, what we're used to in the US are these gigantic, like if you've ever watched The Simpsons, right? Homer Simpson works at the nuclear plant with a gigantic, cooling tower. And that's what we're used to seeing. And those plants will take 10 to 20 years to build. They take years and years to get regulatory approval, which in many cases is impossible. We haven't had a new plant greenlit in the United States in decades. And those plants tend to come in tens of billions of dollars over budget, which is not great. With the SMRs, once you get that design, you can produce them quickly, efficiently. They don't have to be built on site. You could just build them in a central location and just drop them off somewhere. And the key thing is, what scares people about nuclear energy is, oh no, what if it's another Chernobyl or Fukushima or 3 Mile Island? And, the fact that nobody dies in those situations, that we haven't had a death related to nuclear power happen in decades, everybody forgets that. And I understand that fear. But in the case of these SMRs, again, small modular reactors, they don't melt down. You don't have those kinds of meltdowns. Basically, if your core, they're not water cooled. And so if your core melts down, the whole thing just basically stops working. And that's really the end of it. But in general, this is really safe power. But the key thing is, you can't have a meltdown. There's not going to be, that gigantic accidental explosion with, nuclear waste all over the place. These are really safe. And over the next decade or two, people are going to get used to and accustomed to seeing these things literally, on site in places or close to towns. I understand why people are afraid of it, but these are really safe. They don't blow up. They don't melt down. You just don't have that disbursement of radioactive material that, everybody sees in the movies. So the bad news for the monster files, the people who like monsters, these will not cause another Godzilla, I'm sorry to report.
Great stuff there, Gary. Thanks for breaking down that entire segment of this week's version of the 5 things, the Powered by Nuclear power issue. Again, please subscribe to our YouTube channel. Give us a thumbs up on this video or thumbs down. Just let us know what you might disagree with or questions you may have. You can also head over to our website, deepknowledgeinvesting.com. Consider a free subscription. That'll get you access to all of our email delivery, our newsletter, notifications about the 5 things, as well as premium content. Some of that may be gated That's where a premium subscription comes into play. That'll get you access to all current recommendations that Gary has as a part of the DKI portfolio. Also, we have an Ask Gary feature on the website. You can submit questions into the show. Might even see one of your questions show up here on this week's version of the 5 Things. Gary, now moving on to our 5th and final thing. As we mentioned earlier in the show, we have Cash and Crow, DKI intern, on as a special guest. He's going to walk us through our educational topic. Today, we're talking about hedging. So I know DKI has a lot of hedge positions in the portfolio. So going to give a breakdown of that. Gary, thing number 5, I'll turn it over to you. Educational topic, understanding hedging, and introducing Cash into the show.
All right, thanks, Rob. So you're right. The DKI portfolio is heavily hedged. We're trying to isolate very specific bets, very specific investment theses and areas, and to let our stock picking help us make money as opposed to just, riding the beta of market expression or just the direction of the market. But the great news is Cash and Crow, DKI intern from the University of Tennessee, is well prepared to explain to our audience. Cash, and how was your week?
It's going pretty good.
Yeah. Good. All right. And you're back. Where were you in Europe?
So I went to a couple different places, but I was in Spain, Germany, Czech Republic, Hungary, and Croatia.
Outstanding. Love to see you traveling so much. All right. So let's explain it to our audience in the most simple, direct possible way. First of all, what is a hedge?
So this week, hedging and investing, and this is essentially one way that you can use one investment to offset the risk of another. And a good way to think of it is kind of like an insurance policy. So you're using an investment, a different investment, and this would be you kind of paying that premium in exchange for some sort of protection. And you're never going to get an investment that's completely risk-free, but there are ways you can minimize that risk, and hedging is one way to do that. And here at DKI, we've laid out about 4 different ways, common ways that you can hedge investments.
Good. All right. I like the way you described that, and also talked about the fact that it's insurance, right? There is a cost to this. It's not free. There's no free lunch here. You want to protect your downside, you have to pay something for it. I think it's a really good description. Okay, so let's run through the different kinds of hedging we want to explain to people today. And by the way, for our audience, there are dozens and dozens of ways to hedge, but we want to walk you through some of the most commonly used ones. So Cash, and let's talk about a market hedge. What would you do for a market hedge?
So a market hedge is when you're going to take a position that goes against the overall market. So one way to do this would be to short the S&P 500. It's a broad market index, and this is a way that you can protect those investments that are correlated to the market without having to sell individual positions. So a lot of times people are going to short the S&P 500, or maybe if you have something like a tech-heavy portfolio, you could short the QQQ, and
Good. All right. I like the way you described it. So what we would do in this situation is you would own an individual equity, an individual stock, or maybe a portfolio of stocks, and say, I want to live or die with the performance of those stock picks as opposed to the performance of the market. So you would short the market against it. And you're right, you want to use an index that most closely matches the stock position or positions that you're trying to hedge the risk on. So I think that's the right way to think about it. All right, so moving on, what about shorting comparable companies? What would that entail?
So this shorting comparable companies would be where you try to find another company that's highly correlated to the position you're in. And this is also referred to as pairs trading. But for example, if you're bullish on a certain company, let's take AMD, for example, a semiconductor company, and you want to isolate the strengths of that company, but you're worried about overall threats to the industry, maybe the semiconductor industry, you could short a comparable company like Intel, and this short position could offset the overall risk that AMD is going to face in that industry, but you're still getting the potential for AMD to have returns due to those specific strengths that you're trying to isolate.
Exactly. Great description. Now, for people who are, coming at this for the first time, one of the risks in this is if you make the wrong choice, you could end up owning the company that underperforms and being short the company that outperforms. There's no guarantee that it's going to work. And, we just saw recently Intel, they had, new management team. They also announced plans to potentially spin off some divisions or restructure in ways that would make sense. So if you would have had that specific pairs trade on at that time, you could have ended up losing more money in the short than you'd make in the long. And so it's a great strategy, but you really need to get the research right on that one. Is that sound fair to you, Cashin?
Very.
All right, let's talk about another great way to buy insurance, buying put options against your long positions. What would that entail?
Yeah, so buying put options on your long positions is definitely a very common hedging strategy. Like we mentioned, insurance, I would say this is a better example of insurance because it's a way to buy that personal kind of insurance protection on a single position. And this would be where you're basically long on a position and you're going to go ahead and buy that put option that is going to protect you in case the stock in which you own goes down in value. So if it goes down, and as that put option moves closer to the strike price, you're able to capitalize off of the negative return that the stock may experience. So investors using the strategy can still collect gains on their stock. It's not going to be, well, there is still a potential that you're going to lose money, but there is a way that you can still experience gains even if the stock goes up and the put option declines in value.
Exactly. So in that scenario, if the stock that you own goes up a lot, you'll benefit from that, but the put option, that cost is going to be gone, and that's all right. You're buying insurance. The nightmare scenario on this particular way of hedging is, let's imagine a hypothetical situation where you buy put options, say 10% out of the money. So your stock is at $100, you buy 90 strike put options, and if the underlying equity, the stock maybe goes down to 90, 91, 92, you can lose money on the long and have the cost of the put expire worthless, meaning you bought insurance, didn't benefit from it, lost money in both places. That's the risk of it, but this can be a very effective way to limit risk, especially on large long-term positions, right?
Exactly, yeah.
All right, great. Now let's go to a fourth way of hedging, and something that we do in size at Deep Knowledge Investing, buying uncorrelated assets. What would that entail?
Yeah, so a lot of people like to diversify into these uncorrelated assets, maybe even negatively correlated. And these are assets that don't move in sync with much of a portfolio. So, you have stuff like Bitcoin, gold, other commodities. A lot of people like to invest in these when the market may be going through a rough patch because they're able or have proven to be able to perform well during periods of high inflation or market panic. So this is mitigating risk by reducing your overall portfolio volatility, and it can give you a chance to experience gains even when the overall market is going downhill.
Exactly, right. So at Deep Knowledge Investing, we own huge amounts of Bitcoin, we own gold, silver, uranium, other forms of energy. Basically, when I wake up in the morning, I'm focused on the specific news of the companies or assets that we own. I don't spend a lot of time worrying about whether the market's going to go up or down. So buying uncorrelated assets is a great way to make money in positions that don't necessarily depend on the market. Sounds good. All right, Cashin, any other thoughts on this?
No, I think that's about it.
All right. Well, by the way, for our viewers here, for anyone who actually is reading the written version of the 5 things, which we distribute to premium DKI subscribers on Monday and to the free subscribers on Wednesday, you're more than welcome to go to deepknowledgeinvesting.com, sign yourself up for a free or paid subscription. But I want all of you guys to know that on the written version, it was Cashin who wrote this part of it. He's the one who put together the graph, the image for it. So it's our young interns who are doing this kind of work and doing, in my opinion, a phenomenal job. Cashin, great job on this. Really great to hear from you on this.
Thank you so much.
Awesome stuff. Cashin, great work. Pleasure to have you as a part of the show as always, and looking forward to having you on a future show coming up. For everyone else, that concludes this week's version of the 5 things, the Powered by Nuclear Power issue. Gary Lovin throwing in all those powers in one title.
I did that on purpose.
That's right. Be sure to subscribe to our YouTube channel. Head over to our website, deepknowledgeinvesting.com. You can sign up for a free subscription. That will get you notifications on all new content being published on the site. And as always, would love if you would consider a premium subscription. That'll ensure that you do not run into any gated content on the website. Gary, turning it over to you for final closing thoughts.
Well, first of all, Rob, round of applause for our young interns, Kashan and Samak Jain. I mean, these guys just finished their freshman year of college, and they've spent part of their summer traveling all over the world. I think we've been on 3 or 4 different continents as a group already this year. Great to see, but the work that they do is incredible, improving every week. It's just great to see them not only doing high quality work, but taking great suggestions and getting better every week. Rob, I always want to thank you for filming the show with me. Great to have this time together, and for putting so many of Flying V's resources behind what we're doing here at Deep Knowledge Investing. Just know it's really appreciated. And for everybody watching this, thank you so much. We know your time is valuable. We appreciate you spending it with us. If you want to give us a like and subscribe, that would be great. But hey, we're not the boss of you. Do whatever you want. But either way, we will look forward to seeing you guys next week. Thanks a lot.
Thanks, everyone.